Duolingo stock is down 80% from its all-time high. Investors are convinced that Duolingo will be disrupted by artificial intelligence, and the company is intentionally suppressing its own profit growth. But could this crisis present a huge opportunity for investors to buy a compounding machine with multi-bagger potential on sale? Today I'm breaking down Duolingo's stock crash, the AI threat, and their new strategy for long-term dominance. I'll reveal the exact price I'm willing to pay for Duolingo stock towards the end. Since the start of 2026, Duolingo stock is down 36%, while the S&P 500 index is up around 8%. This is a huge divergence. Of course, Duolingo with its $5 billion market cap is much more volatile than the index. Mid-cap stocks like Duolingo tend to trade up or down more sharply than large-cap stocks. However, Duolingo's poor performance is less about stock volatility and more about its business strategy, which we'll cover in a bit. But the real story here is that Duolingo stock has been hit by the software sell-off, or the SaaSpocalypse as it's sometimes referred to in the media. Investors believe that artificial intelligence is a real competitive threat to the entire software industry, with companies like Anthropic expanding into enterprise, offering AI solutions to businesses via Claude. Whilst many investors like myself see the AI threat as overblown, it's still possible that many businesses will be disrupted by AI-centric competitors. Whether they go out of business completely or suffer with lower profit margins is anyone's guess. This chart shows the stock performance of the top 10 holdings in the IGV ETF. IGV is the main ETF for the software sector. As you can see, Duolingo, whilst down 36%, hasn't been hit as hard as Intuit, which is a much larger company at a $100 billion market cap. That's 20 times the size of Duolingo. Even a company like Palantir, which has been on a tear over the past 5 years, hasn't avoided the hit. But with Duolingo down 80% from its all-time high, what's actually going on here? Investors believe that the AI threat is real. Duolingo is just an app for learning languages. Surely its moat can't protect it from ChatGPT or Anthropic. These AI chatbots can act as translators. Who would want to learn a language when they have access to a free AI translator? And even if you're still determined to learn a language, just ask ChatGPT to teach you. These LLMs can provide real-time conversation, grammar correction, explanations, roleplay, and pronunciation feedback. This directly competes with Duolingo's offering. If a $20 a month AI tutor is better than Duolingo's $12 a month gamified lessons, consumers could shift away from Duolingo. But I see things slightly different. Instead of a competitive threat, I believe artificial intelligence could be a huge tailwind for Duolingo's product, and the company is already proving it. In their latest earnings call, Duolingo described AI as fundamentally changing what's possible. Duolingo launched over 20,000 new course units in Q1, which is more than 10 times the amount of new courses they published 2 years ago in the same quarter. And those 20,000 new courses released in the past 3 months matches their entire output from 2025. Management notes that this accelerated output is still constrained by a quality bar. So while the bears say that AI is killing Duolingo, the company itself says that artificial intelligence is enabling it to produce more content and therefore providing more value to their users. Duolingo recently reached 56.5 million daily users in the last quarter, and this is a huge factor in their AI success. In order to create courses that meet Duolingo's quality standard, they need data so that they can identify what works and what doesn't. And Duolingo has lots of user data thanks to its huge user base. No other language learning app has this many users. Combining that data with AI to accelerate content production is how Duolingo have increased their output at such a significant pace. Before I show you my valuation model for Duolingo stock, there's another important factor to be aware of. Duolingo recently announced a controversial new strategy that Wall Street really wasn't happy about. The company has decided to prioritize long-term user growth over short-term monetization. While this sounds promising as a long-term investor, Wall Street isn't in the long-term game. They hear that monetization will be sidelined, which equals less profit. Then they update their valuation models and see a lower fair value for the stock, and announce they've downgraded the stock to a sell and lowered their price target. As long-term investors, this is the kind of noise that we need to filter out. Yes, there are fundamental factors to pay attention to, but analyst price targets aren't one of them. So how are Duolingo actually progressing in this new strategy? Here's what you need to know. Daily active users grew 21% year over year in Q1, in line with the 20% growth target. Management's expectations for 2026 daily active user growth remains around 20%. Daily active user growth is broad-based across regions, with Asia being the fastest growing region. Monthly active users was roughly flat in Q1. The team is explicitly working to re-accelerate this. Historically, word of mouth is the key top of funnel driver. It's powerful but less directly controllable than retention or pricing. Retention continues to improve due to ongoing product work. Daily active user to monthly active user ratio keeps increasing nearly every quarter and did so again in Q1. So the business is still growing daily users at a decent rate. The slowing monthly active user growth is a real concern though. Monthly active users were described as the top of the funnel. Basically, they're the first step into Duolingo's ecosystem. The idea is to increase the rate of monthly active users who become daily active users, who are then more likely to become paid subscribers. That's where the money's made. Here the company mentions that roughly 12% of monthly active users are paid subscribers. Management believes this should be much higher, benchmarking other freemium models. Next, we're going to look at how Duolingo is planning to increase growth by improving the user experience. Duolingo say they're improving their free tier, with more features and content available to free users, providing a better experience than a few months ago. Remove and avoid monetization tactics that hurt daily active user growth. Find monetization levers that do not trade off engagement for revenue. This is the actual mechanism Duolingo is using to prioritize user growth over monetization. Longer free trials are an example of a non-friction monetization lever. Historically, Duolingo used 7-day free trials. Longer trials, for example 1 month, are testing well. Increased bookings, good user value, and not at odds with daily active users. The team intends to experiment with even longer trials, for example 3 months. Enabled by the 2026 operating framework that tolerates delayed bookings. This move by Duolingo to push longer free trials is designed to get those free tier users into the paid Duolingo ecosystem, because once users get used to the extra features provided by the paid tier in their free trial, the likelihood of them cancelling is pretty low. Next, we're going to look at Duolingo's current valuation. Then I'll show you my valuation model, including the return investors can expect from Duolingo stock if bought at today's price. The first thing to note is that Duolingo's price to earnings ratio makes the stock look cheap, trading at 12 times trailing 12 months earnings. Trailing 12 months means it's based on the previous 12 months earnings. However, due to analyst expectations for declining earnings per share, Duolingo's forward PE ratio is actually much higher at 42 times. As we discussed earlier, Duolingo's focus has shifted from monetization to user growth. This decision is the reason why analysts have lowered earnings expectations. If we compare Duolingo to another company with a similar freemium-based business model, Spotify trades at a much more reasonable 28 times forward earnings. Although it is fair to point out that Duolingo, despite slowing growth, is still growing revenue much faster than Spotify. Duolingo's revenue growth rate, represented by the green bar, was 27% last quarter versus Spotify's 10% in red. Both Duolingo and Spotify have growing operating margins, recently reaching around 15% on a quarterly basis. This suggests that in normal market conditions, Duolingo and Spotify shouldn't trade too far apart in terms of their PE multiple. Before we move on to the DCF calculator, I wanted to show you something that I mentioned in a previous video about Duolingo, their cash position. With $1.25 billion in cash, up from $1.14 billion last quarter, Duolingo trading at a $5 billion market cap currently trades at about 4 times its cash position. This is extremely low. For reference, Spotify currently has $10 billion in cash with a market cap of $90 billion. That's 9 times their cash position, significantly higher than Duolingo's multiple. This suggests that the market and investors are heavily discounting Duolingo stock due to the bear thesis we explored earlier. If we look at a business like News Corp with declining revenue in a dying industry, it has a market cap of $15 billion and $2 billion in cash. That's a 7x multiple versus Duolingo's 4x multiple. The market is pricing Duolingo like it's literally going out of business. The real question for investors is this really the case? Next, let's head over to the DCF calculator on Qualtrim to find out the return Duolingo stock could provide for investors if bought at today's price. We've got to come up with some assumptions for Duolingo's earnings per share growth rate over the next 5 years, and an appropriate PE multiple for the stock to trade at. In the short term, Duolingo's earnings per share are expected to fall as the company shifts strategy from monetization to daily active user growth. Duolingo's goal is to reach 100 million daily active users by 2028, a significant jump, nearly doubling in 2 years. You'd expect that after reaching 100 million daily active users, the company would turn the monetization lever back on, meaning earnings per share could increase dramatically after those first 2 years of neglect. Add to that share buybacks. Duolingo could buy back shares with its $1.25 billion in cash, which would automatically boost earnings per share. The company has already authorized $400 million worth of buybacks. If the market cap stays the same, that's almost 8% of Duolingo's total shares outstanding. With all that being said, I think it's reasonable to assume that if you don't subscribe to the bear thesis, Duolingo could grow earnings per share at a rate of 20% annualized over the next 5 years. Let's add that to our model. Now for the PE ratio. Over the past year, we can see from this chart that Duolingo's PE multiple just fell off a cliff. It was re-rated due to slowing growth, which, to be honest, looking back at that 250 PE ratio was definitely fair. At 250 times earnings, no reasonable investor would go near that thing. However, at 12 times earnings today, assuming the bear thesis is wrong, which they usually are, Duolingo stock is likely to be re-rated if management can execute on that 100 million daily active user target by 2028. I think even a 20 PE ratio would be conservative, but I'm going to use it anyway. Based on these assumptions, you can expect Duolingo stock to increase from around $115 today to $420 per share in the next 5 years. That's a more than 3x increase, or just over 30% annualized growth. Remember that valuation is subjective, and these assumptions rely heavily on Duolingo's business model surviving what many investors perceive as an existential threat from artificial intelligence. However, despite not owning the stock, I hold the view that Duolingo will not be disrupted by AI, and that Duolingo will actually use AI to increase their lead in the educational technology space. Have you ever heard of Duolingo's closest competitor? It's called Babbel. And yes, I had to look that up. That's how far ahead of the competition Duolingo currently is.